Hello, everyone. Ladislas Morius from the wanderinginvestor.com. So today I'm really excited to be talking to Tim Steremos about African frontier stock markets. Tim, how are you?
Good, thanks, Ladislas. How are you doing?
Good, good. So I'm here in Paraguay. You're in Dar es Salaam, correct?
I am, that's right. Just back from a quick visit to Hong Kong, back to Africa, where the action is.
Good, good. And you've been living in Tanzania for how many years now?
It's going on 2.5 years. Came in late 2020, September 2020, and been here ever since.
Good, good, good. So let's talk about African stock markets, because I think one of the big learnings from 2022 is the fact that these markets seem to be completely uncorrelated to the rest of the world, really, even to other emerging markets. Can you elaborate on this theme?
Yeah, sure. We look at around 17 different markets here in Africa. Not every country has a stock market, but the ones that do, they had a good 2020 and I say 2022. Most markets around Africa, the GDP growth is still in the low single digits, mid single digits, and I guess the level of correlation between GDP growth and the stock markets here in Africa is still there. There are a lot of places around the world where economies are doing one thing and stock markets are doing another. Uh, U.S. markets, terrible year last year. Here in Africa, our fund, we made money. It was one of the pleasing things about the fund that I had been telling people I thought would happen, and sure enough, that is what did happen. The economies here are sort of at an earlier stage of development, obviously, and simple industries that we saw do very well in developed markets 30, 40, 50 years ago are still very much growth industries here. So valuations on the businesses are low already. That could also be a factor in this, that a lot of the gains in recent years in developed markets where people did very well were actually not necessarily due to the growth of many of the businesses, but because of the valuation gains from lowering of interest rates. So when interest rates started going up very, very quickly, we saw that effect come through in the markets. The downside, I guess, here in Africa is you don't have as much of an investor class as you do in the developed markets. So probably the people that are investing in equities, they're people that are not struggling for money. They're among the local elites, and their behavior doesn't change greatly from year to year. It's sort of steady as it goes. Those are some of the things that I can point to as being, perhaps behind that level of, non-correlation, as you say. But the bottom line is that I think there's a long runway for growth in basic industries here, and that's something that I think, regardless of valuations, people are able to compound money over a very long period of time, and that's one of the attractions and why I came here to set up the fund, a few years ago.
Yeah, and ultimately, it's these markets are cash markets. There's zero leverage in the game. It's only people who have cash who can invest. So that brings less immediate upside, but also less immediate downside in many cases. There's not that leverage effect, unlike in our Western markets.
Correct.
So
People are not sort of under pressure from falling prices of other assets that they need to raid the piggy bank, as it were.
yeah, but I think that's what a lot of investors in your fund were quite happy with, was seeing that they were up on the year versus the rest of their portfolio, apart from energy, if they had been invested in energy, being down. So can you tell us, because I mean, Africa is big, it's easy to say Africa, Africa. Can you tell us about the country allocation of your fund? Because typically when people invest in Africa, they go and they buy some random ETF in London or New York, but your approach is very different. You invest on the local stock markets. So your fund has brokerage accounts on all of these local stock markets, and you invest in local blue chip company. So what's your current country allocation?
Yes, that's right. We have a country allocation that would be quite different from any ETF that people might see trading on a developed market. I am based here in Tanzania. This was the market where I came back in 2018 to have a look at things on the ground for myself, and became attracted to the valuations of some of the dominant blue chip businesses. I since moved here, built a good network here. It's the place that I know best, and it's where I saw the most opportunities in the short run, and that's reflected in the allocations that we have here in the fund. I don't set out to get a particular percentage allocation to any one country. The only rule I have is that no more than 50% of the fund can be invested in one country based on the cost that we go in at. So over time, obviously, if you put 50% of your money in one country and that country does very well, it might rise as a percentage of the overall basis for the fund in market value terms. But on a cost basis, 50% in Tanzania has sort of been my cap, and we're very close to that. We're at 48.6 at the moment, but it's climbed in value to be 58.4% of the fund as of yesterday's market closing. I was just updating everything earlier today. So we do have a dominant position here in Tanzania, and not a lot of other funds investing in this part of the world would have anywhere near as much of their assets allocated here. So I think that stood us in good stead because this market has been doing well.
So why that much to Tanzania? Because I mean, I lived in Africa for 7 years, traveled all over. It's quite random to have over
Exactly.
50% of your
It's
allocation.
it's more of a bottom up. It's a result of me finding enough good businesses here to invest in. I've spent some time since I started the fund also in Kenya on two separate occasions. I spent several weeks there. I also made a trip over to Lagos back in September. So I'm looking at trying to find businesses in other places that A are as attractive, and B where the country macro environment is also attractive. And unfortunately, a lot of countries at the moment are struggling with things like parallel foreign exchange rates and other macro factors that are not particularly attractive to an overseas-based portfolio investor such as myself. I'm not saying Tanzania is perfect, but we haven't had any of these kinds of issues crop up. Doesn't mean that they won't crop up at some time in the future. But it's a combination of those two things: favorable macro conditions, and then also the fact that there are enough high quality businesses trading here locally that I've been able to buy in quantity. A lot of other funds are a lot bigger than ours, and that probably means that a market like Tanzania is, it's too small for them to get a large percentage of their capital allocated here because of that size factor. So that's another part of it.
Can you
The
give us an
biggest,
example of a company, and because you're talking about good value and good businesses, et cetera, can you give us an
yeah,
example
sure.
of a
So
business?
our largest holdings are the dominant brewery here in Tanzania, Tanzania Breweries Limited, which is a subsidiary of Anheuser-Busch InBev, which is based in Brussels, which is a conglomeration of lots of different beer companies around the world. They acquired the Tanzania brewery business by their acquisition of SAB Miller a number of years ago. And it has around 80% of the market here. It's a young demographic here. Every year you have 1.5 million kids reaching drinking age, graduating high school, and so on. So there's a great tailwind for their business long term, in my opinion. It's also a very well managed and efficient company. Of the most efficient breweries on the African continent, 4 of the top 5 belong to Tanzania Breweries here in Tanzania. The 5th one is a brewery in Uganda that also belongs to Anheuser InBev's subsidiary there, Nile Brewing, which is not a separately listed entity, so we could never buy that. But that's one of the big holdings that we have. We also own NMB Bank,
But
which
before we
is
go there, can we elaborate? Just take it as a case study. So, what's the PE ratio? What are the debt levels? What's the dividend yield? Kind of what are, a few
okay.
metrics?
So the way that I look at valuations starts with the return on equity that a company is generating, or the return on invested capital. And in these markets, given that you can get a good rate of return on government bonds, in the low teens in many cases, I'm looking for businesses that generate at least 15% return on equity unlevered, and ideally double that. So Tanzania Breweries is somewhere in the low 20s, depending exactly what you back out of the calculations and so on. But it's a high quality business, is what I'm saying, and that it generates a high return on equity. The price to earnings ratio at the moment it's tricky because there are two separate prices for this stock. One for the block trades that I have access to, and one that retail investors here on the local exchanges have access to. But on our cost basis, we're in at about 10 times earnings, and the dividend yield is around 5%. So it's not super cheap. I'm happy to pay up for a high quality business like that. The beauty is it's completely debt free. So it's a net cash balance sheet, and it trades at a reasonable multiple of the equity as well.
And
So
what were its growth figures last year in USD terms?
So we haven't got the final results out, but they're back to double-digit top-line growth, and EPS growth is even faster than that because of the operating leverage. So you have a company that's trading on about 10 times earnings and growing at more than that. So there are a lot of sort of benchmarks that people use with investing, but one of Peter Lynch's favorite ones was to have a price to earnings growth ratio of less than one, and he was always seeking businesses like that. Peter Lynch being the legendary manager of the Fidelity Magellan Fund, who has one of the best track records in history, really. And he retired early and went off and did something else. So hats off to him.
So you mentioned something a bit earlier about two different prices. So one being the price for
Yes.
retail investors and the other one being for block investors. Can you elaborate on the concept of block
so
investors?
one of the quirky things about a lot of these African stock markets is that they have somewhat perplexing trading rules. Also in other places, not just in Tanzania, but for example in Nigeria, prices won't change on the exchange unless at least 100,000 shares turn over in a session for that particular company. And that's whether the shares are 1 cent or $100. So it's not the amount of money that matters, it's how many shares. So that's an arbitrary rule. Here in Tanzania, they have a similar arbitrary rule where a certain percentage of the company's shares have to turn over. And then the price on the stock exchange will change. But at the moment, Tanzania Breweries is such a big cap company, and the price has got out of whack, and the amount of shares that have to trade to change the price on the board, it never happens. So there's a kind of a parallel market that the stock exchange has sanctioned, where any investor who has at least 200 million shillings to spend can buy from another investor who's selling in sort of a larger block. 200 million shillings here is about 85,000 US dollars. So I guess if you're a fairly big retail investor, you could have access to that board. And the block off board block trading, and I've done that also personally. But it is an impediment to some of the local investors to trade in those large blocks. And it means you can get a price.
Do blocks trade at a premium or at a discount?
So they're trading at a discount because there are people who have been holding these shares for a long time and were at higher levels, and they want out. For example, foreign investors redeeming from Africa and so forth. So a lot of what we've done to build our portfolio in Tanzania has actually been to buy blocks from people that were going in the other direction, which has worked very well for us.
Cool. So
you mentioned an example of, you really need the local knowledge, and it's one of the reasons that I'm here on the ground, and I've come to, ferret around in the minor details, not only of what companies are doing, but also the way that shares trade on the exchanges and the little quirks like this. I don't think that a lot of the guys managing funds like mine sitting in Chicago or New York are really involved at this sort of a nitty-gritty level. I mean, their brokers they delegate this to other people, but those other people are not at the, they don't have the interests of the investor directly at heart. They have the interests of the fund manager that's placing the order at heart, and how the money comes, it doesn't really matter to them. So there's one of the unique things about the fund that I run, which is hopefully going to continue.
Yeah, I mean, there's definitely value to be created by being there on the ground rather than sitting in some London office, for sure. For sure, for sure.
Yeah.
I think it gives people a good overview of what you're investing in. So, just breweries, cement companies, just normal everyday businesses. You also invest in banks and all that.
Banks, yes. And mobile phone companies are another big part of the listed company space here in Africa. Those are probably the three main sectors: financial services, mobile telephones, and basic consumer products, consumer staples.
Cool. Fantastic. Thank you. So what's your biggest, because I mean, 58% allocation to Tanzania, what's your biggest risk in Tanzania?
For every country, foreign exchange rates is probably the main risk for a foreign investor, which most of my clients are. The dollar obviously has been strong, and every country here tends to run an inflation rate that's a bit higher than the developed world, although that's changed in the last 18 months or so. So foreign exchange is always a risk. And we did have a situation in Ghana, which is another country where we've invested in a very good business, MTN Ghana, which is the leading mobile phone company there, where the exchange rate has more than halved since we started investing. So we've obviously been hurt by that, given that we record our results and report in US dollar terms. So that's also a risk here in Tanzania over the longer term. So we keep close eyes on whether the country's balance of payments trend is sustainable, how much money they're borrowing from overseas, whether the level of import cover, in other words, how many months of imports that the current level of foreign exchange reserves that they hold can pay for. So there are certain critical indicators that we track. We do think that at some point the exchange rate here will depreciate, but we're not, too worried about that in the near future. Other risks are obviously political. These countries are not as stable as some, although again, you look at Western countries these days, and are they really more stable than Africa? Some of them are certainly not. It's really funny the way the world has changed. So I look at macro risks, the main two being political risk and foreign exchange rate risk. Those are really the top of the list.
Talking about foreign exchange lists, so your fund has about a 5% allocation to Ghana, and I mean that country just literally went through, the currency just imploded. It's going through a debt default. It's going to have to go through
Yeah, they're
restructuring.
doing a renegotiation with their foreign creditors as well as their domestic creditors. So
So
yeah,
how
to give
did
you an idea
how
of how
how
that
did
can
this
impact the
impact you?
performance. Yeah, so we had an exposure on a cost basis in Ghana of, so this is based on how much money we've invested. We had about 1/8 of the portfolio in Ghana, just over 12%. So that has now fallen to be just under 5%. So basically, we've been cut in half and then some, and largely due to the exchange rate. So this is one of the risks. The company I mentioned before, MTN Ghana, they've been growing so fast that their earnings per share have actually compounded at about the same rate that the currency has devalued. So in US dollar terms, we're basically treading water. So this is a classic example of what can happen when things really do implode. The issue with Ghana was that they had a lot of earnings from abroad. They're a big exporter of gold. They're second in the world in cocoa after Ivory Coast. They also have a significant hydrocarbons industry that sprung up here over the last decade, and the government seems to have gone on a massive borrowing and spending spree based on the projections of what they were going to earn in royalties from this hydrocarbons industry. At least this is my shorthand interpretation of it. And they basically mortgaged the future and then spent the money and then some, and all of a sudden people realized that, well, maybe there isn't going to be enough money left to roll over or pay back these euro bonds that they took out. So it was a case of the politicians' eyes getting dollar signs and going and borrowing far too much more than they should have. And that's the thing that does not apply currently in Tanzania, but I watch it quite closely. They have been adding to their foreign debt pile, but the difference is that they don't have any outstanding euro bonds where they're really answerable to the capital markets. They're all sort of bilateral loans and soft loans from development aid institutions and so forth for the most part. Ghana, unfortunately, seems to have gone down another road, and the politicians there are still refusing to cut back much on their spending. There's an infamous example of a cathedral, a national cathedral, and a museum that they just refuse to lower the budget of, even though things have hit the fan, as it were. So it's a risk for sure. The foreign exchange rate risk is always number one, as I said a short while ago.
I mean, all these countries in Africa once in a while go through a big devaluation. But Ghana, I mean, it's been their history. Ghana has always had two things going on. One, a great narrative, and a lot to show for it too. But two, just a terrible currency. The Ghana CD is always collapsing. I mean, when I was working there for a few years, I was running the P&L of the Nestle dairy business in Ghana, and when I arrived there, I arrived in the midst of a devaluation, and we had to do pricing scenarios. I remember for about 2 months during the peak of the devaluation, we were redoing our whole pricing scenarios 2-3 times a week. It was hell.
Yes.
We had price increases every week, every 10 days. It was a lot of sleepless nights.
I bet. Yes, it's interesting, in some of these countries that there are businesses that can function very well, even in this very hostile operating environment. And Nigeria, I would put in the same category. I spent some time there in September, and boy, if ever there were a country that had macro challenges and difficult operating environment, that's it. And
3% allocation to Nigeria.
There's a story behind that we may not have time to go into today, but Nigeria at the moment is almost uninvestable because they have a parallel foreign exchange rate system where, as a foreign investor, if you sell something for Naira in Nigeria, you have to join a queue at the central bank to get your money out, and it's taking 9 to 12 months. So it's not a country I want to put a lot of money in
for sure. Like strict capital
parallel
controls.
exchange. Yeah.
Parallel exchange.
So the election in Nigeria was held over the weekend, and everyone's hopeful that there will be change once the new president comes in and starts shifting things around. But we'll wait and see what happens. It's by no means a certainty.
Cool. So for now, you're just keeping a 3% token exposure to Nigeria, but yeah, that's it. It sounds very reasonable. It's not a market I would rush into. So you have approximately an 8% allocation to the West African Stock Exchange. So that is the Francophone one. So Ivory Coast, Burkina Faso, Senegal, all that.
Mali.
This seems a little low. Is it because you're English speaking, or?
No, although I would like to be able to access more financial reports and so on there personally instead of having to delegate it out. There just aren't enough large, high quality companies. Is basically the answer. We own a significant position in Sonatel, which is the West African subsidiary run out of Senegal, or Orange from France.
So telco.
Yeah, basically mobile phones, mobile money, and that's a high quality business that's generating good returns on equity, pays out a very healthy yield. They actually reported earnings last week, and the dividend has increased again to a net after-tax dividend of 1,500 West African francs, and our entry cost, I think, for those shares is 11,400. So if you do the
Nice.
maths, we're on a nearly a 15% yield
Nice.
for that one,
And it's in
which is
euros.
good.
I mean, the West African
It
franc
is,
is pegged to the
although
euro.
that didn't help much last year when the euro went below parity. We got hammered on the FX there as well, although it's since bounced back. There are really not a lot of companies listed there that offer the size and the liquidity that we can take a significant enough position to make a difference for our fund. But I will be always on the lookout, obviously, and I would like to have some more exposure. It's an area of the world where there are opportunities, and
I
we'll
remember
keep our eyes open.
when I was working in West Africa, I was managing both Ghana and Ivory Coast at the same time for the milk business. And generally for West Africa, what we could see is when the Anglophone countries were doing well, like Nigeria, Ghana, etc., the Francophone countries weren't doing too well. And when the Francophone countries were doing well, then it was the other way around with the Anglophone countries because their whole structures, their whole economies are completely different. Though in many cases they export the same products, but because the Anglophone countries have their own currencies, which they can devaluate, etc., but the Francophone countries don't. They essentially just stick to the euro. The cycles are actually surprisingly different.
Okay, that's interesting. At the moment, I think a lot of the countries over there are struggling, but being commodities exporters, if we are in a new commodity bull market, hopefully that changes here over the coming decade.
So tell us about ever disappointing Kenya.
Yes, Kenya is a market that we have invested in several companies that unfortunately are doing all right, but their share prices are not. There's a big bear market in Kenya at the moment. A lot of people are disillusioned with the share market. There is some fundamental reason for that, given that the country, again, like Ghana, has also got a lot of foreign debts that they have to roll over or pay back. And there's been a situation where there's even a foreign exchange scarcity. A lot of people are hoarding dollars in Kenya in order to hopefully get a higher price for them in Kenyan shillings down the line. So it's not quite as bad as Nigeria, but a parallel exchange rate has started to develop. And if you want your money out of Kenya, you need to be accepting of a lower exchange rate than the official one. So there's a large spread that's opened up. But Kenya went through their elections last year, and there was a fairly smooth transition of power to Ruto from Uhuru Kenyatta, and they're still sort of feeling their way, the new government, and we're still hopeful that the reality is not as bad as the doom and gloom in the stock market. I know you visited Kenya as well last year, or maybe it was even the year before, and had a look around and met with the CEO of the stock exchange there. So businesses are offering great value, and the better companies are still growing their earnings and everything's fine, but there's just no enthusiasm for anybody to invest in Kenyan stocks at the moment. Locals are giving them a wide berth and just keeping their money in T-bills and bank accounts and real estate, stuff like that. So until there's some sort of a catalyst to change that mood, I'm not really expecting Kenya to set the world on fire. We have got positions in some of the companies there, and as long as we can earn a good dividend yield and the companies are delivering on what we thought they would, then we just have to wait for the macro to turn around, and that's the situation. It's a bit of a waiting game.
So I think this is a very good lesson, not just for stock investors, but for real estate investors, is that when you invest in these emerging markets that have current account issues, there's a real risk in terms of getting your money out. So countries can have a current account deficit for a long time and be completely fine if there's enough foreign investment coming in. But it's always a risk. You can buy. So, for example, if you had bought an apartment in Kenya and you were like, "Cool, I've had it for a few years. I want to exit my position." Great, you can sell your apartment in Kenya, but then trying to get your money back will be complicated. So legally you're allowed to, but then you might find yourself in some foreign exchange queue whereby the bank tells you, yes, sure, we're going to send your money when we have the dollars. And then you're just there sitting in Kenyan shillings. So you sold your apartment in Kenyan shillings. You have Kenyan shillings in your bank account. And now you have to wait until there are dollars. So I remember having this with my salary when I was in at the peak of the currency crisis in Ghana when I was working, and sometimes the bank didn't have dollars, and I was just sitting there with a whole bunch of CDs that were devaluing by I don't know like 2-3% a day, and then only after 5-6 days the banker would send me an email and say, "Hey, I have some dollars for you," and then it's just whatever exchange rate the bank gives you, you just say yes, 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 and then you get your money out. So it's a risk, you sell your property 200K, let's say in shillings, and then you have to wait 3 weeks, 4 weeks, maybe just 5 days, maybe 2 months to for the bank, especially a big amount. You're not connected. It's not like you're a politician that knows people, etc. You're not going to be at the front of the queue. You're actually going to be at the back of the queue, and in the meantime you lose money. So what happens is when you have parallel exchange systems that get put into place like this, is it just kind of freezes the market. People don't necessarily want to, or people that have cash, locally cash, want to buy something, anything that they can get hold of, um, but people don't want to sell. That's the issue. People don't want to sell, so the volume in the market just decreases.
They're hoarding their dollars very much so in Kenya, and you're exactly right. So if you want to get money out, the official rate is 127, but good luck getting that. You're going to have to pay 134, 135, or so you give up that spread.
Which is
What we
fine,
do is
three
yeah,
paying
yeah.
four
I mean, you're
percent to get
better
your
off
money
taking
out,
it when you can get it. Yeah.
take
When
it,
you can get it, just take it.
run.
Right.
But
And
that's the beginning.
we try to build this factor into our system, in that we're looking to compound our money at 14.5, 15% a year, double every 5 years if possible in US dollar terms. Well, that means we have to be compounding it a lot faster in local currency terms, and that's how we try and factor that in. But it does make life complicated on occasion when everyone starts to hoard their dollars and the market doesn't function the way it should be. So actually, we had a situation in Kenya where there was a block of BAT Kenya shares that came up for sale at a very decent price. There was a foreign investor wanting to sell to switch into something else. And rather than send money into Kenya, what I decided to do was I decided to liquidate an existing position and get shillings that way. So I liquidated something that I thought was, it's still good value. I owned it, but it was less good value than the other one that I wanted to switch into. So rather than send fresh money in, I just rotated. And that's the sort of tactical thinking that you sometimes have to come up with.
Cool. And you have a 9.5% allocation to tiny Rwanda.
Yes, Rwanda is an interesting one. It's a fairly well managed economy in the context of Africa. Not a lot of companies there listed, and they trade almost by appointment. So we have been fortunate to buy decent positions in both the leading bank there, BK Group Rwanda, which is, I think it accounts for over half of the financial industry. And then one of my favorite stocks of all in the portfolio is the Rwandan beer company, or the leading brewer in Rwanda, which is called BRVM. It's a Heineken subsidiary.
You seem to like
And
beer a lot, Tim. Do we
yeah,
need to
well,
talk
there
about
are
this?
a lot of people here that like beer, and it's hot and you're thirsty, and anyway, beer tends to sell well. But Heineken is the majority owner of that and runs it. The company has, I think, again, 80-90% market share. Obviously, that depends on sort of what imports are not accounted for, which is always an issue. Illicit trade in alcohol and cigarettes happens everywhere in the world. But these guys are also the leading Coca-Cola bottling plant in Rwanda, so they dominate both beer and soft drinks. And again, there was a foreign investment fund that had made a lot of money in this company over the years and were happy to exit at one point last year. So we were glad to buy a position from them. The only way you really get to buy a significant number of shares is if there's another holder that wants to exit in a hurry among the foreign investment crowd. And we have done well on both of those positions, which means that the share of the fund that's dedicated to Rwanda has climbed over the years and probably will continue to do so. Currency there has also been, weak, but not catastrophically so. It's depreciating at a steady rate of 3-4% a year, which is manageable.
That's good. I mean, one of the biggest risks of investing in such frontier markets is corporate governance. And by investing in these subsidiaries of large Western companies, essentially you have two tiers of auditors that are going in there. You have the local auditors, and you also have the auditors from headquarters or from Deloitte that are being sent from Europe or wherever, who come and go down and check out the operations and do all of that. So as an investor, this is an additional safeguard. It's, that these businesses are being audited on a few levels, which is very reassuring. It reduces risk a lot.
I didn't deliberately set out to have a portfolio weighted towards these kinds of companies, but when I run my investment screens and what they spit out tends to be these companies, and we ended up with a portfolio like that. But I'm basically looking for dominant companies that have very good returns on capital and are well managed. And these are the companies that end up making the cut. And it's interesting that that's how it's evolved.
Yeah, and that's what I like about your portfolio is you're invested in different industries across very different geographies. So, like what happened in Ghana last year, the country blowing up, these things are going to happen to other countries as well. And, Ghana blew up, but hey, guess what? Senegal was doing great. So that's why having a diversified allocation is important, because at any given point, something in your portfolio is going to be blowing up. That's just, it's just how things work in Africa. 2 steps forward, 1 step back, 2 steps forward. So, no, that's good. Taking a step back and just looking at Africa as a whole. Right now, people don't seem to be focusing too much on the continent. There's things happening in Europe. There's a lot of tension in East Asia. People seem to have completely forgotten Africa. It barely ever makes headlines. What is your kind of macro perspective for the year or the next few years ahead? Do you think there's going to be a renewed focus on the continent? Are great powers, because China is extremely active in Africa, but lately a little bit less. It's been lending a bit less money. The US, is saying they want to be more active in Africa, but they say this, but end up never really doing anything. The French are getting their butts kicked out of West Africa gradually by the Russians. Like, what's your overall take on what's happening on the continent? I know it's a complex question, but
I guess to keep it simple, the global geopolitics, I think everyone is interested in Africa to an extent. And China obviously had exerted a lot of influence over the last 15, 20 years. And the perception was that perhaps the US had taken their eyes off the ball. China has noticeably stepped back, I think, relative to what they were doing prior to COVID. They might come back with a vengeance. I don't know. I haven't seen any evidence of that recently. But the US seems to have stepped up its level of interest, never mind that it's pretty busy fighting fires both at home and in Eastern Europe there. So in Kenya, in particular, there seems to have been a renewed push by the United States to take an interest. They have sent a very high-profile ambassador to Kenya, Meg Whitman, who was involved in eBay, I think, and used to run one of the big US tech companies. And there's also been some high-profile visitors to Africa recently. Janet Yellen, the former Federal Reserve chairman. She was in several African countries recently. Jill Biden was visiting Kenya just last week. She might even still be there. So I think the Americans have kind of tried to show their face more often around Africa, whether that translates into actual investments picking
or
up
just
pace
threats.
again, I'm not sure. But there's a strategic interest, I think, to counter Russia and China here in Africa. So there's that element of a geopolitical theater, proxy wars is probably too strong a word, but certainly they're trying to one up each other around the place. And a place like Tanzania probably benefits from that because Tanzania has always been non-aligned. They're quite happy to take investments and have foreign relations with any country. There's a Palestinian diplomatic mission down the road. The Iranian embassy is around the corner. There's a Cuban embassy here in Dar es Salaam. So it's not like they're pariahs that they won't deal with. And, the Chinese are certainly here in a big way. The Americans are here in a big way. But everyone is welcome. And,
And your fund is there
the
in a big way.
railway exactly. The railway that they're building, the high speed railway, I should say, is it's a Turkish company that's building that. So there's a lot of interest from many different countries, and I think that's beneficial. Obviously, there are other countries that are very closely aligned with one of the big powers. Zambia, for example, is very aligned with China, and Kenya probably in hindsight, are a little bit too closely aligned with China and took a little bit too much debt on for the infrastructure construction from China. And now I think the Americans are seeing that as an opportunity to come back in. And it's one of the reasons why Kenya may be not in as much trouble as people think. It's kind of why I'm a little bit more sanguine on Kenya. I don't think Kenya necessarily goes down the tubes like Ghana did, because I think the Americans might be working behind the scenes to provide some assistance. There's a big Euro bond repayment that has to be made early next year. And I think they're going to get the money. But the markets are being very cautious. And, there's some good values in Kenya at the moment for that, justifiably so, because my view is probably not the consensus one. But that's what makes a market.
Good. Yeah. And just as a reminder, your fund is Sub-Saharan Africa, excluding North Africa and excluding South Africa, because the dynamics are completely different.
The bit in the middle, which it actually makes it quite unique. There are a lot of frontier Africa funds, but they'll either have exposure to North Africa or South Africa or both. So, we don't have money in Egypt, we don't have money in South Africa, and that's what makes it a little bit different.
Yeah. Cool. For transparency's sake as well, so we had done videos in the past. I said that I was invested in your fund. Since then, I think like 3 months ago, I exited my position, not because I don't think it's a good long-term investment. I actually saw it as retirement money, but I had to take money from my retirement fund to get involved in some real estate investments here in Latin America. So, I mean, I'll be back, Tim, for sure. It's just I needed the float in the meantime. And it took me, so if people wonder, it took me approximately, once I gave in my documents to cash out, within 2 months, I had the money in my bank account.
Yeah, I think it all went fairly smoothly. So hopefully that's satisfying. Yeah, we have another investor who's doing the same thing, and yeah, it's a long-term opportunity. So Africa's not going anywhere. When you're cashed up again, I'm sure you'll come back into the fold, and we look forward to that.
Look, I see it as the best way to play Africa. I mean, having worked there and lived there, I understand the operational challenges of trying to do business in Africa, of trying to manage property remotely in Africa. I've made that mistake. I'm still paying the price in one of the African countries I invested in. So I see the value of just choosing the best local businesses and just sitting
Yeah,
and
just kind of delegate it to them, let them worry about all the operational hassles, and we
yeah,
just collect the dividends, and hopefully over time also see some capital growth as other
yeah.
foreign investors see might and join us. That's kind of our strategy.
And then having auditors do the due diligence for me, that also helps because I also was on the receiving end of property managers running away with some of my money. So yes, I
Yeah,
understand. I
it's a
understand.
tough operating environment. Yeah.
Yes, so
And
very
I
tough.
say the same thing to people. I mean, you and I have a network of friends who are quite entrepreneurial and so on, but it's a difficult place to be an entrepreneur or try and do a private business. And yeah, I say my strategy is the polar opposite. I've gone for the big dominant businesses run by professional managers and with oversight from usually some multinational, and it works well.
Yeah,
It's
and
a
they
strategy
deal with the
I feel
crap. You look at the
exactly. That's right.
numbers, you look at the macro, they deal with the
Yeah.
crap, and
Yeah.
I completely understand. I think anyone who's lived and worked in Africa completely understands your position. Cool, fantastic.
Yeah.
So, if anyone is interested in learning more about African stock markets in general, I really recommend Tim's newsletter. So, there's a link below, and once in a while, he sends essentially information from the ground, insight from the ground as he's traveling, going to the different markets on the continent. So, it's very insightful. I enjoy reading you.
Great.
Cool. Tim, thank you very much for your time. I really appreciate it.
No worries. It was nice to be back on. Hope your real estate deals will work out for you in Latin America. Sounds
Thank
like
you.
fun.
Cheers.
All right. Yes.
You can go to my website, thewanderinginvestor.com, and sign up to the private list. It's entirely free. This way, you will be getting insider information as I travel around the world looking for opportunities. Lastly, feel free to follow me on Instagram at The Wandering Investor. I look forward to hearing from you.